The market spent the last 18 months treating the solar sector like a terminal patient. But if you look at the schematics, it wasn't a heart failure. It was a clogged artery. The solar winter was a mechanical inventory glut, and this GreenCandle autopsy shows the patient is not only breathing, but starting to sprint. We are deconstructing the architecture of Enphase energy. Ticker symbol ENPH. Forget the saving the planet marketing fluff. We're here to look at the plumbing of a high-margin monopoly that just finished a brutal but necessary renovation. Enphase has spent years building a digital fence around the American roof. With 89% of their Q4 revenue coming from the US, they are effectively a bet on domestic energy autonomy. They aren't just selling parts. They are selling a software-defined microinverter ecosystem that is nearly impossible to rip out once installed. While the international mix sits at a modest 11%, the real story is the monetization of the residential grid. By controlling the inversion, the process of turning raw sun into usable power, they've positioned themselves as the mandatory operating system. It's hardware with the soul of a software company. Management is running a masterclass in asset-light engineering. They shipped 1.31 million units from US facilities in Q4. Not just for the logistics, but to harvest the 45X production tax credits. They are effectively using the tax code as a secondary revenue stream to fortify a massive $1.51 billion cash pile. But look at the January restructuring. They cut 6% of the workforce to lean out for a long-term fight. The goal is to compress quarterly operating expenses down to $70 million. They aren't just surviving the cycle. They are optimizing the machine. Optimizing the machine. Traditional string inverters are a relic of bad design. One shaded panel can drag down the entire system's output. Plus, running 1,000 volts of high voltage DC across a rooftop is a liability most homeowners don't understand until it's too late. Enphase's ASIC-driven microinverters decentralize the risk by performing the conversion at the panel level. They ensure that if one module fails, the rest of the grid keeps humming. It's an engineering solve for a physics problem. Physics problem. Physics problem. The retail herd is still crying over a 29% drop in European demand. But the true signal is in the American channel. Q4 US sell-through spiked 21%. The strongest pulse we've seen in 2 years. The inventory overhang isn't just shrinking. The pipes are finally clear. That 39% gap up in early February wasn't a fluke. It was a 50 million share short covering riot. When 22.7% of the float is betting against you, and you guide for a $300 million revenue floor, the math breaks the bears. The market realized the floor isn't falling, it's actually rising. You can't just disrupt Enphase with a cheaper product. They have 22,000 certified installers locked into their ecosystem. For an installer, switching to a competitor means retraining every technician. It's the ultimate switching cost moat. Their Power Match software further tightens the screws, improving battery performance by up to 40%. While competitors try to compete on the price of the metal, Enphase is competing on the intelligence of the system. Compare Enphase to SolarEdge or First Solar, and you'll see why it commands a premium. Despite a 5.1% tariff headwind, they maintained a 46.1% gross margin in Q4. While others are drowning in inventory hangovers and margin compression, Enphase is maintaining elite tier profitability. They are the alpha of the distributed energy transition. They've successfully commoditized the panel while keeping the inverter proprietary. For years, the margin story was held hostage by Chinese battery tariffs, but the spider web is being untangled right now. Enphase is taking delivery of its first non-China sales this quarter. This isn't just a logistics update, it's a systematic removal of a massive tax penalty. As these non-China sales scale through the first half of the year, the tariff bottleneck disappears. When you pair a 21% jump in demand with a cleaner supply chain, the operational leverage starts to look like a coiled spring. The plumbing is fixed. Now the pressure is building.
Anchor is the European residential market, which is still struggling. But the rocket is the commercial IQ9 microinverter, which just hit the docks in January. They are finally moving beyond the suburban roof into the industrial park. Looking ahead to 2028, the company is betting heavily on bidirectional EV charging. They want the vehicle in your garage to be the ultimate node in their grid, where the roof is just the starting point. If you want to know what management really thinks, look at the safe harbor disclosures. They secured over $120 million in deferred revenue contracts. That's guaranteed visibility that hasn't hit the top line yet. They are building a foundation while the neighbors think the house is on fire. Let's keep our feet on the ground. This business is still sensitive to interest rates and distributor whims. This GreenCandle analysis isn't a get-rich-quick scheme. It's a recognition that the cycle has turned. It's about recognizing the difference between a broken company and a broken market. Broken market. The market is still staring at the 46.1% margin and sighing. What they're missing is that 5.1% tariff penalty that's about to evaporate. When Q2 earnings hit the tape this summer, the scaling of domestic sales is going to trigger an unmodeled EPS explosion. The data shows that 60% of the recent volume came from dark pools. That is institutional accumulation, plain and simple. The bear target of $44 is the gap fill if the macro environment turns sour again. The base target of $60 is where we see multiple normalization, as the $270 million revenue floor is confirmed. The bull target of $85 requires the commercial IQ9 to beat expectations. It's a matter of how much the market is willing to pay for a regrowth story. The February 4th gap up from 38 to 52 was a structural trend reversal. You don't clear the 50-day moving average on 7.5x relative volume by accident. The institutional point of control is anchored at $48. That's where the big money has staked its claim in the sand. We are looking at an accumulation zone between $48 and $51.50. The ripcord is $43.50. If it closes below that, the short squeeze was a head fake, and the gap is gonna fill. Discipline is the only thing that keeps an investor from becoming a bag holder. Bag holder, bag holder, bag holder, bag holder. Enphase has spent the last year being dismantled by the market, only to rebuild itself into a leaner, more efficient version of its former self. By clearing the channel and fixing the supply chain, they've engineered a fundamental recovery. This is a GreenCandle moment, where the physical reality of businesses has outpaced the pessimism of the ticker. The solar winter hasn't just thawed. The ground is actually starting to move. Starting to move.